The watch market just had its 13th straight quarter of price declines, but you'd never know if you're only watching Rolex and Patek. Some brands are holding strong, even gaining, while others are in free fall, down over 40% from retail. We are seeing tariffs shaking things up, certified pre-owned explode, and a sharp divide between brands that collectors trust and those they are walking away from. So in this video, I will break down the biggest winners and most painful losers, the side facts you won't believe, and what all of this means if you're buying, selling, or just watching the market unfold. So this is the Q2 2025 watch market report. So let's get started. And on a quick note before we get into it, this is all taken from the watch charts and Morgan Stanley watch reports. I think you can subscribe to the newsletter, or you can, make yourself an account there, and then you will receive that same report as well. I can only highly recommend it. It is very informative, and this is where I've got the statistics from. So like I said, go subscribe to that, or just get an account. It is really great. So let's have a look at the data, and we're going to start with the big picture and set the scene so we can all start on the same page, because the secondary watch market might finally be finding its footing after more than 3 years of consistent declines. You might have already watched my other video that I did about the last market review, and from that you know that things have not been looking too great. But let's see what updates we have now that we're 6 months into 2025. So the second quarter of 2025, prices on the secondary market fell just 0.3% quarter over quarter, which means we're comparing Q2 of 2025 with Q1 of 2025, the lowest rate of decline since the second quarter of 2022. That is also the 30th consecutive quarter, so one right after the other, without skipping a month of price drops. But at least now the descent is more like a slope than like a cliff and a sharp fall down. So yay for that. I mean, you can clearly see that the curve is slowly but steadily sort of flattening, no crazy ups and downs, which is always great. So what's behind this soft landing? Well, that is obviously not a simple black and white reasoning. And unfortunately, it is not the whole market that's stabilizing. What or who is really the key driver here are really just 4 key brands doing the heavy lifting. Very obviously, we have Rolex, Patek Philippe, but also Omega and Cartier. Rolex, Patek, Cartier, and Omega all delivered steady to slightly positive results in the second quarter of this year. These brands continue to sort of lead the market, more or less within the respective price ranges. Rolex and Patek Philippe at the high end, with the prices above, like on average, like 10,000 and above, and Omega and Cartier in the mid-range. So about like $3,000 to the $10,000 price range. So as of Q2, they remain top performers both for the quarter and over the past year. This consistent strength shows really that consumers' demand remains focused on the well-established so-called blue chip brands, while smaller watchmakers are finding it harder to compete. A trend, I have to say, that has continued from the first quarter. This isn't something that is like super surprising or shocking. We've already seen that development before. And these aren't just random outliers. These brands, they hold the largest shares of the secondary market, and their relative strength is hiding, unfortunately, the broader market's weakness. And here's the kicker. Outside of these 4 that I've just mentioned, nearly all other brands saw price drops. Of the 24 brands they track in this report with an average retail price of $3,000, 18 of them experienced price declines of at least 1% compared to the previous quarter. The only notable exceptions were Tudor with a plus 0.1% and Bulgari with a negative 0.2%. So in total, 29 out of the 35 brands posted negative results for the quarter, with most losing more than 1%. And although the watch chart's overall market index has appeared stable so far this year, that figure is, largely driven by a handful of strong performers. The reality beneath all of this, the surface, is a more uneven and polarized market, which becomes clearer when looking at the performance of specific Swiss watch groups as detailed, which we're now going to talk about. So while headlines might say the market is stabilizing, what's really happening is polarization. So in this context, polarization means that the performance of the secondary watch market is becoming increasingly divided between a few very strong performing brands and a large number of weak ones. So while top brands like Rolex, Patek, Cartier, and Omega are holding their value or even gaining slightly, most other brands are still seeing significant price declines, And this sort of creates this gap where the market isn't moving like as a whole thing, as a group. Instead, it's splitting up into winners and losers with very, very little middle ground. So if you're holding something outside of the top 4, odds are it's still losing value. It's a trend we've seen developing since 2024, but the second quarter of this year really confirms it. The secondary watch market is being propped up by just a few strong performers, and the rest is still pretty much on a shaky ground. So let's take a closer look at the top performers and see how they're doing. So while most of the watch market is still trending downwards, a very small group, like I've mentioned, is pretty much defying gravity. I just watched Wicked. So those highly trusted, iconic names that collectors and investors tend to flock to when the rest of the grey market is really super shaky. So in the second quarter of 2024, 4 brands stood out for their strength in the secondary market, which is, as I said, Patek Philippe with a plus 1.1% quarter-on-quarter. Cartier with a plus 0.9%. Rolex has a negative of 0.2% quarter-on-quarter, which is almost like a flat thing. And Omega is barely down with a negative of 0.1% Q-on-Q. So, but why does it matter? Because these 4 brands together dominate the secondary market by volume. They have the most listings, the most interest, and the most influence on the overall market trends. So let's break them down a bit. With a 1.1 increase, Patek was the best performing major brand in the second quarter. The Aquanaut and Nautilus collections played a big role. No surprise here. The Aquanaut was up 2.2%, and even the new Cubitus collection, goodness me, commanding at 79.9% premium over retail. Who would have thought that anybody was going to buy this? But yeah, people seem to love it that much. Cartier too surprised the market, which I'm very happy to hear. I love my Cartier. So prices rose 0.9% Q-on-Q, largely thanks to the strong demand for the Santos collection. No wonder here, which is trading at just negative 23.3% discount. Relatively good compared to its peers. Even more interesting, Cartier was the only major brand whose value retention actually improved, albeit slightly, by I think it was 0.6 percentage points since April. I mean, yeah, I guess we still have to add that while Cartier's value retention improved by 0.6 percentage points, it did so as a result of the discontinuation of many highly discounted models on a like-for-like basis. Its value retention still declined by 2.2 percentage points. Oh, and this, when I say like-for-like, this means the analysis compares the same specific models across 2 time periods. So excluding any new release or discontinued models, it helps really to isolate the true performance of unchanged inventory by removing the noise from any like catalog changes that might have happened. So for example, if Cartier discontinued some poorly performing watches in the second quarter, its average value retention might look like it improved, but the like-for-like value retention would reveal whether the models that stayed actually performed better or worse. So it is a cleaner, more kind of apples to apples comparison. So just so you know, that's what like-for-like means. So yeah. All other brands saw a sequential decline in value retention, both with and without adjusting for like-for-like models, but it did decline most for Patek Philippe and Audemars Piguet, largely as a result of retail price increases. And I will put up a graphic that you can see while Tudor and Cartier were the least ones affected. And let's move over to Omega. Omega saw a minor dip at 0.1%, but held up better than most of its peers. Its Speedmaster line continues to lead, no surprise here, with a value retention of negative 29% compared to the negative 35% average across Omega, which I think isn't all that surprising, though you still, read a lot about how people get more and more annoyed by the endless stream of speedy releases. It is still the most iconic Omega and an entry into the brand for most people. Obviously closely followed by the Seamaster line with the Diver 300M, for example, or the Aquaterras that now have gotten some refreshing updates too. Like it very much. So yeah, and finally we have to take a closer look at Rolex. Of course, Rolex stayed virtually flat at 0.2% Q-on-Q, negative 0.2, which in this market is still a win. The Datejust and Oyster Perpetual collections even posted gains, with the Datejust having a plus of 0.7% quarter-on-quarter and the Oyster Perpetual with a plus of 0.6% Q-on-Q, which I think is a really cool development to see a shift from, at least for me, bulkier sporty models like the Submariner and the GMTs to more classic, less sporty lines like the Datejust or the OPs. Would be interesting to see if there's a correlation between a changing taste in luxury accessories and other worldwide happenings. I don't know, maybe this is too much of a stretch. Just something that I just had to think about. I'm sure there will be some kind of statistic that correlates with this. But yeah, I mean, you can see it for yourself. It's the losses in sports models like the Submariner and the Yacht Masters that are both down. I think it is negative 1.3%, which are holding back the overall results for Rolex. Right, so we have talked about the winners, the ones that are holding up this whole thing. Let's see who exactly it is that is underperforming and what might be the reason behind it. Because while a handful of brands are keeping the market stable, the vast majority are still poo-pooing on it, sliding down, and some in pretty dramatic fashion, if I might say so. In fact, out of the 35 brands tracked in this report, 29 had a negative price performance in the second quarter of 2025, and 25 of them dropped by more than just 1%. And I want to start out with the biggest shocker, Vacheron Constantin. Once a flagship name in haute horlogerie, it posted the worst value retention of any brand. It's negative 41.1% below retail on average, and its secondary prices fell a negative of 3.4% Q on Q. And just so you know, this isn't at all an indicator about quality or any kind of evaluation, or more specifically devaluation of the design or craftsmanship or anything like that. I mean, these figures could potentially imply these things, but they remain hard facts that have multiple factors playing into them. So please, if you love Vacheron, don't call me a dumb bitch in the comments because I'm discussing statistics here. I like them too. Just letting you know. Thank you very much. Let's get back to it. So it's 56 and other collections trade at negative 38%, nearly negative 50% below retail. And only one model from the overseas collection is selling above retail. And even that one is an outlier. Right, but let's move over to Audemars Piguet, AP, part of the so-called Holy Trinity, also Vacheron too. And yet for the first time, its average secondary market prices fell below retail. Its value retention is now at negative 1.3%, which marks a down from plus 5.3% in April of this year. That's a 6.6 percentage point drop. And this drop is mainly due to a plus 6.7% retail price increase, while secondary market prices actually fell a negative 1.4% at the same time. So that kind of plays into all of this. And here's the twist as well. 61% of Audemars Piguet's models still trade above retail. It's just that the brand is dragged down by poor performance, like you've got the Royal Oak Offshore with a negative 22.7% value retention, the Code 1159 that they like to just shove into your face when you're at an AP boutique is down a shocking negative 33.3%. They will shove it down your throat if you're in an AP boutique. They'll be like, buy this, you don't get anything else, you have to buy this first. So, but yeah, it doesn't stop here. Other major brands lost serious round in Q2. So, you know, let's quickly have a look here too. So we've got IWC, for example, down 37.4% in value retention. Tudor with a 39.7%, A. Lange & Söhne down 36.7%, and Omega at a negative 35%. Secondary prices for these brands fell despite rising retail prices, which were meant to, you know, kind of offset the US tariff hike that we had going on in May. That's still going on. But instead of boosting value, who would have thought, the price hikes seem to have widened the gap, surprise, surprise, between retail and resale. But yeah, I don't want to be all doom and gloom here. There's also been one fun little outlier. You might have already noticed from the graphs that I have already shown you. We have Tissot with a bit of a comeback, we could say, after being the worst performer in Q1. Its secondary prices rebounded 1.5% Q on Q in the secondary quarter of this year. So yeah, you go, girl, Tissot. Congratulations. So yeah, that was cool to see. It is a small but meaningful recovery, especially at the entry level, you know, where buyers may be more price sensitive and responsive to bargains. So yeah, the key takeaway here is this: the polarization in the market is sharper than ever. While a handful of blue chip names hold steady, you know, many respected brands, even some from the big three, hello, Vacheron, AP, are struggling with falling demand, aging inventory, and eroding resale value. It is no longer just about brand prestige. It's about specific collections, timing, and price dynamics. And that makes navigating the market more complicated than ever, but also more interesting than ever, if you ask me. It's extremely fascinating to see how, you know, swift decisions from bigger and smaller watchmakers impact their performance, and how sometimes watchmakers rely on pretty much one single collection to keep like the whole ship afloat. Right, so let me quickly say this. If you're not interested in Rolex CPO, then you can just skip this chapter and go on to the next one. But let it be said that you will miss out on one of the most surprising developments of this report. So yeah, I advise you to still stay on even though you're not the biggest Rolex fan. This entire Rolex CPO is something that's quietly becoming one of the most fascinating stories in the watch world to me. The Rolex Certified Pre-Owned program. So it was launched in the late 2022. The RCPO was Rolex's bold move to take control of how its watches are sold on the secondary market. And now in the second quarter of 2025, it's growing fast again. Didn't think that was going to happen because after a pause in the first quarter, the CPO added 12 new retailers and 30 new stores this quarter, which brings it to a total of 116 retailers with 227 stores with roughly 8,500 watches in inventory that hold an estimated value of around 190 million US dollars. So yeah, didn't think this was going to happen. We saw a decline of retailers that were part of the CPO program, but now they have obviously watched my video. Just kidding. No. The report estimates that the sales in this quarter will hit $120 million, and that would be a plus 20% increase compared to the 100 million in the previous quarter. And I talked about this in my last report video, and we can still see that the top selling models remain pretty much the same, which are the Datejust, Oyster Perpetuals, closely followed by the Submariners, the GMTs, and the Daytona, which is now very similar to the models that gained in value retention too. So very interesting connection here. In terms of pricing, Rolex CPO is still very much above the, let's call it regular secondary market premium. The global average CPO premium is now at plus 30.8% compared to non-certified listings. And what's even funnier, if you can call it that, is that the range is wildly depending on the retailer itself. So it's not like every Rolex CPO has some sort of standard pricing. So for example, the 1916 company from the US exhibits the lowest markups with, I think it's just about plus 16% on average, whereas Bucherer, which is European, is the most expensive, hooray, with an eye-watering plus 42% premium. It is crazy for sure, and I wasn't really prepared to see that big of a difference in pricing because I kind of thought, like I said, that they sort of had a similar pricing model or some kind of Rolex mandated pricing standard, but I guess I was wrong. So yeah, that's just on a little side note to give you an update on the CPO situation because we talked about it the last time, and I'm extremely curious to see how this is going to turn out as the year continues, especially how prices are going to develop. When we get closer to Christmas, I think this is going to change a lot too. As of now, it seems Rolex is betting on brand trust to drive the segment, judging by the 120 million in quarterly sales, it's working. And some of you all are buying these watches for those prices. So I don't want to see in the comments being like, who's buying this? A lot of people are. I mean, 120 million. There are people who are willing to pay this. And I mean, fair enough. But yeah, let's shift our focus back on the other brands. More specifically, I want to talk about the middle of the market. So the middle ground of the brands like Cartier, Omega, IWC, and others that are in the 3K to 10K price range, kind of like the sweet spot, and see how they're doing. So at first glance, it looks like these mid-level brands are gaining traction. But once you peel back the layers, the story gets a little bit more complicated. So in the second quarter of this year, demand for mid-level watches on the secondary market remained strong, even as retail sales continued to struggle. So we're seeing record highs in both supply and sales for brands like Omega, Cartier, IWC, and even Vacheron Constantin, despite its value drop. It might sound like a resurgence, more listings, more buyers, more turnover. But here's the twist. Despite all this activity, secondary prices for the same brands continue to decline. So let's, just look at a few examples from the value retention leaderboard. You've got Omega trading at negative 35% below retail. IWC sits at negative 37.4%. Like I said, Vacheron at a painful 41.1% negative. And even Cartier, the best of the bunch, is still down at 28.2% negative. Why, you may ask? Well, in part because retail prices increased across the board, largely in response to the US tariffs that kicked in on May 1st. So, for example, Cartier had an increase of 2.8% and Omega showed an increase of 4.3%, and VC Vacheron had an increase of 6.5%. So now you've got higher retail prices and falling secondary market prices, which is a perfect formula for eroding value retention. So this growing disconnect between primary and secondary prices suggests a bigger trend. So buyers are skipping the boutique and going straight to the resale market. With those hikes, retail prices are starting to feel prohibitively high, especially for brands that don't have the same prestige cushion as Rolex or Patek, for example. And that's exactly what the report predicts, that the secondary market may benefit at the expense of retail sales if this pricing gap continues. So yes, these mid-level brands are seeing more action, but it's not a comeback just yet. It's more like a shift in behavior where buyers are looking for better value outside the showroom, and perhaps that is something you might have already experienced for yourself, that your first thought no longer goes directly to the boutique and the boutique experience. If you think about buying a watch, you just go online immediately to check prices if you're interested in a new watch on the secondary market. So yeah, if this trend holds, it definitely has the potential to reshape how those brands that are sitting in this middle position themselves in the next few years and how they intend to gain back those customers. I mean, we have talked about what's happening above the surface, pricing, brand performance, and market polarization, but now I would like to dive into what's really moving the market behind the scenes. We've got two major forces at play right now, which is tariffs and retail price hikes and changing market health fundamentals. I know this might be a lot, but stick with me here. It gets very interesting and it's important. So in Q2 of 2025, every single China brand raised its US retail prices. Highly unusual and unified move, but I mean, politics. Patek Philippe led with a plus 6.9% increase. Then you've got Audemars Piguet with a 6.7% increase, and others like Vacheron with a 6.5%, even RWC with 5%, Omega 4.3%, and Rolex with 3.1%. These price hikes were largely in response to the 10% US import tariff that went into effect on May 1st. But here's the thing, these higher retail prices are not being matched by higher resale values. In fact, despite raising prices, brands saw their value retention, that is how much of the retail price they keep on the secondary market, fall across the board. So let's look at the examples between April and July of this year. For Patek Philippe, the value retention dropped 7.4 percentage points. Audemars Piguet had a drop of 6.6, Vacheron is down 5.2, and even Rolex dropped at 2.7 percentage points. Only Cartier, saw a minor value retention improvement, but that's largely due to, like I said, discontinuing underperforming models, so not actual resale growth. So while retail prices are rising, secondary market prices are either flat or falling, and this widening gap is changing how consumers behave. So pushing more buyers toward the secondhand market, especially in the US. But that also raises a critical question. How healthy is the market underneath all of this? So let's dig into that now. So among the big three, Rolex shows the strongest fundamentals right now. And what I mean by this is that their inventory supply is shrinking. So lowest levels in 5 quarters right now. Then we need to look at the absorption rate. So the rate at which watches are sold is the highest in 6 quarters. And we have the age of inventory that is dropping, meaning, just fresher, faster moving stock. This shows that Rolex is balancing supply and demand well. I mean, they've always been doing that quite good. And dealers are pricing inventory more effectively. But the story isn't as bright for Patek Philippe and Audemars Piguet. The total supply for both is climbing to record highs, and their age of inventory is concerning. Your average Audemars Piguet watch is 223 days old, and a Patek Philippe watch sits for an average of about 175 days. That means many listings are 6 to 8 months old, just sitting unsold basically, and that's not even the end of it. The age of inventory is more than double the days on market for both brands. And yeah, secondary prices are still falling for them. That tells us that demand is up, but buyers are price sensitive and dealers are discounting to move volume, not to preserve value. So what's really going on here? Well, retail prices are rising, mostly due to tariffs, but secondary values aren't keeping up, and that's creating cracks in the market. Overall, Rolex looks solid, but Patek and AP is oversupplied and aging, and the mid-level brands are selling but not gaining ground in value. It is a market driven less by hype and more by fundamentals, as you can see. And right now, those fundamentals are signaling that sellers need to be smarter and buyers are, getting pickier. But yeah, before we're going to summarize everything that we talked about just now, I want to take a quick breather because I want to highlight some weird facts that I found within all of this that I'm sure you'll find as interesting as I do. So yeah, here are your talking points for the next Watch Me tab. Let's start with this fun one. Out of nearly 400 Omega models tracked, only one trades above retail, and it is the Silver Snoopy Speedmaster. It's a 310, 32, 42, 50, 02, 001. Thank you for those reference numbers, Omega. All other Omega models are selling at least a negative 9% on discount. So yeah, a big shout out to the Silver Snoopy Speedmaster. Despite rising demand and good turnover, Omega's average value retention still sits at negative 35%. We talked about this. And its Planet Ocean and DeVille lines are down more than 40%. And then we've already touched on this. We have Vacheron Constantin, which just became the first brand Morgan Stanley tracks to drop below negative 40% in value retention. The worst performer 3 quarters in a row. Yay. And while its overseas collection is the brand's strongest, even that only trades at a negative 12.2% discount, which is one model selling above retail. It's the 4520V 210A B128, a blue dial stainless steel variant of the overseas. So yeah. And a little bit about one of my favorite brands in the market where most collections fell. The Panthère from Cartier line defined the trend. Prices jumped plus 9.8% Q on Q and plus 9.3% over 6 months. So good job, Cartier, for that. It is, still a small volume collection, but notable exception worth watching if the trend continues. I love Cartier so much. So yeah, anyways, just some little side facts that I think are noteworthy and interesting. Definitely always cool to see some less in-your-face things and facts that still have an impact for the brands. And yeah, let's bring all of this together now. Let's summarize this. So the Q2 2025 watch market report paints a picture that's more nuanced than just, recovery or decline. It's a market in transition, definitely stabilizing in some areas, but under pressure in others. And so overall, the watch chart's price tracker declined just 0.3%, which was the lowest drop in 13th straight quarters of negative movement. So that is a good thing that it is all flattening out and that it's not steep decline anymore. But this apparent stability was almost entirely due to just, the 4 brands. You've got Patek Philippe, Cartier, Omega, and Rolex, and everyone else still sliding pretty much. 29 out of the 35 tracked brands declined in Q2. I've talked about this in the beginning, and 25 dropped more than 1%. So this means that the market is becoming increasingly bifurcated, so splitting into 2 distinct groups with very different performance outcomes. So between these, they call it the blue chip survivors, and everyone else that is struggling to stay relevant pretty much. Every tracked brand raised retail prices in Q2, in some cases by nearly 7%, largely to offset the US import tariffs that happened in May. But unfortunately and very unsurprisingly, that backfired for many. Value retention dropped across the board, especially for Patek, AP, and Vacheron, now down to a record of, I keep harping on about this, but it's just so shocking, 41.1%. Underneath the pricing headlines, market health tells deeper truth. For Rolex, it means inventory is fresh, demand steady, and turnover is high. For Patek and AP, the inventory is aging, supply is climbing, models lingering up to 8 months without being sold, which is tough. I mean, that is old. Mid-level brands show strong demand, but like I said, buyers are still very price sensitive and discounts are now the norm, which, I mean, as a buyer, it's great. As a seller, not so much. So where does this leave us? Where are we now? The market isn't crashing, but it is no longer driven by hype. I want to very cautiously say the froth is gone. Pricing is more rational, I would say. Buyer behavior is more cautious and brand performance is more exposed than ever. I would say things are normalizing somehow. We've had crazy years to look back on, and now it's just slowly, how do you call this? The pendulum is not so much swinging out as much. It's in the middle. It makes sense if you're German. There's a saying. Anyways, if you're collecting, flipping, or investing, whatever you do, this is the time to understand the difference between desirability and durability in terms of watches, because only a few brands are proving they still have both. And you need that if you want to make profit, I guess. And that is all I have for you today. I know this has been a long video. I hope you enjoyed this. what surprised you the most in this report? Anything that you did not expect? What are your thoughts about the future? Let me know what you think in the comments down below. And as always, if you have enjoyed this video, make sure to give it a thumbs up and subscribe to my channel to not miss a new video. And thank you so much for watching, and I hope to see you in my next one. Take care. Bye.